Um, awesome. So welcome everyone to our first webinar hosted with Freedom Property Management and Sales. We're very happy to have you join us. We are a professional property management and real estate firm located in Manassas, Virginia. And I am so happy to have several members of our team on who are going to drop some amazing knowledge bombs after the train goes by. I'm going to hand over this meeting to our host tonight, our fabulous realtor, Rebecca Webb.
Well, hi, everyone, and I'm Rebecca with Freedom Property Management and Sales, and we are really looking forward to this webinar. Senior Loan Officer Angela Gansor with the Maya Group has got a chock full slide presentation that she is about to dig into with us about the home buying process. So we will also make this available by a click link later so that you can watch at your leisure, and the slides will be available so that you can move at your own pace at your desired time. A little bit about Angela. She's been in the industry for 24 years, and she works by referral only. She is relationship driven. She does a relationship driven business model, and she's got lots of technology bells and whistles. One of the reasons that we love hearing from her and hearing her updates. She's a Virginia native, married with 2 children. A huge sports fan, loves the outdoors, spending time with family, and paying it forward. Angela also has an incredibly handy app that you can download on your phone. Really, once you're in the home buying process, it's going to get extremely user-friendly in terms of uploading important documents and also getting pings about any transactional activity updates. If you are not in the home buying process, the app is very good if you just want to get on and get some sense of what your financing picture may look like in terms of your loan. The Maya Group and Angela Gansor is one of our preferred lenders. Our team at Freedom relies on Angela for the latest and best loan and financing information and all things related to mortgage lending. And we are thrilled to be with her on this webinar and really hear a lot of this great knowledge that she's about to share. Thank you all so much for being here, and let's get going. And it's over to you, Angela. Thank you.
All right. Well, thank you for that amazing introduction. And hopefully everyone can see my screen now. Just a quick thumbs up. We good? Okay. So welcome everyone. Thank you, Tiffany and Rebecca and Freedom Property Management for asking me to co-host this evening with everyone. Hopefully we will share some tidbits and nuggets that you can take away with this and dispel some, of the horror stories that are lingering out in the universe about being scared to buy a home. So again, welcome to the first time home buying process. Thank you again to Rebecca for hosting this and reaching out to coordinate everything. She's already given a wonderful introduction, so there's not much left for me to say. Again, I'm Angela Gansor with the Maya Group at Intercoastal Mortgage. All of my contact information is in the slide deck. We will also make sure that it is all available for you as well. There is a QR code on this screen specifically, but again, we can get all of that information over to you. I'm happy to field any very specific questions when the time comes. So we're going to go at a fast clip tonight. So I am hopeful that you guys are ready to learn. Just a quick overview. The objective here, homeownership is much more beneficial and attainable than most anyone thinks. Really want to dispel, like I said, all of those horrors that are out there that it's so hard to become a homeowner. We just want to educate you on the benefits that you really can achieve the dream of homeownership. The brief little agenda we've got here, we'll go over some of the pros and cons of homeownership, buying versus renting, preparing yourself for homeownership, personal finance, we'll debunk some myths and misconceptions, and then obviously we'll talk to you about how to compete in the current market. So first things first, don't be afraid to stop renting. We definitely want you to know that if you're affording most of these rental payments that you are making every single month, it's highly likely that you are in a position to become a homeowner and make your money actually work for you. So what is a first-time home buyer? It doesn't mean you've never purchased a home. You can be in a position where you've never purchased a home before, or if you owned a home years ago and for whatever life event reason, maybe you've been renting for the last 3 years or longer. As long as you've had no home ownership in any property in the last 3 years, then you qualify as a first-time home buyer. So there's a lot of programs and grants and different things that could be available to you. So definitely we would want to peel back that layer of the onion and see what other perks are potentially available for you as a first-time home buyer. So it's not the old school, I've never purchased a home and that's the only way to become a first-time home buyer. So some of the pros of becoming a homeowner: it helps you build wealth. The house is going to continue to appreciate in value. You get tax benefits. So when you are going to file your taxes year after year after you've owned a home, that tax, the interest that you pay is tax deductible. You have stable costs. Yes, real estate taxes and homeowners insurance can fluctuate, but if you're in a fixed rate mortgage, you know exactly what your payment is going to be every single month for 30 years, if it takes you that long to pay off the mortgage, unless you refinance somewhere in the meantime or you buy and sell again. You have the pride of home ownership. That's the American dream, right? Everybody wants to be a homeowner. As well, you should. Everybody should have the right to own a home. Can rent, you can rent your property down the road. If you start to build a real estate portfolio, and that property could turn into an income producing property for you. So that is a possibility. And in most cases, a mortgage payment can be less than your rental payment. Some of the cons: here's the first one. You don't get to call the landlord in the middle of the night if a hot water heater breaks. It's on you, but at the same time, then you know you're fixing it and it's exactly what you need and want it to be. So that's going to fall on your shoulders. If the roof, so home repairs then become your responsibility. There's not someone else to call. Upfront costs: yes, you have to put money down. Yes, in this market, typically you are going to be responsible for your closing costs. There are some instances that maybe that can be negotiated in the contract. And your payment sometimes could be a little bit higher depending on how much money you put down on a particular property. It's rare in this market area. Home values can decrease. We're not immune to it, but we live in a pretty good little area in the Northern Virginia, DC, Maryland area with the jobs that we have around us and the economy. Home depreciation is very rare. It can occur. So at least we want to at least make everybody aware. So there is an increasing gap in wealth from renters to homeowners. So as you can see on the chart here, as time goes on, that gap widens more and more and more. So there is a huge benefit to becoming a homeowner so that you can already be on that train and amassing that wealth year over year. Whereas as a renter, you're just going to pay and you're just going to stay flat and you're not gaining any of that equity that you would build in a property. This next illustration is going to go over buying versus renting and some of the bigger numbers that maybe will hit a little bit closer to home. So in this illustration, you're going to see that buying a home at $500,000 versus renting. Buying in the first year, your monthly principal and interest is going to be just over $3,000 in this particular scenario. This is not every scenario. I just want to make that clear. And we've got placeholders here for approximate real estate taxes, maintenance and repairs. So you've got this average here, and we're using a rate of about 6.5 to quote this. So here your rental payment would stay, right around that $2,500 mark. And as rents continue to increase year over year, by year 7, you're already almost paying exactly what you'd be paying year 1 of your mortgage. So appreciation gain, you can gain over $173,000 in that time frame in that 7 years. Amortization, again, you're coming up with some nice good numbers there. So the cost to sell, if you were to sell in that first few years, you're going to lose out on the real estate commission, and that's it. You're still coming ahead with the benefits of the home ownership. Again, your home is going to be sold for $673,000. You pay off your note and you pay the real estate agent. You're still walking away with a nice chunk of change. So to put that in a little bit more perspective, your net gain by buying that home in that 7 to 10 year period, you're coming ahead about $115,000. So it's a big, big number. So what do we want to gain from all of that? The cost of renting versus buying. If you're waiting for prices of homes to go down, especially in this area, you're going to wait a long time. So it's quicker and better to go ahead and just jump in the game. So that way you're already a player in the game. And then when you find another property that you may want to take advantage of, you've already built some of that equity to go on to the next home, whether you're buying up or buying down. It gives you those options that you wouldn't necessarily have if you were still renting and just jumping into the game a few years from now. This is a snippet of the average days on the market that a home has trended in this area. It's not exact county to county. This is just a snippet of the Virginia area, the Northern Virginia area, I should say. So I think that these numbers are not 1000% accurate, but it gives you a good average. Even today, I don't know that homes are staying on the market 19 days. I would be shocked. We just need more inventory. That's probably the biggest challenge right now. People are ready to buy. People are capable of buying. We just need more inventory. So the process. So this is a 10,000 helicopter view of, the process itself. First and foremost, you really do. You want to become pre-approved before you even necessarily engage your real estate agent, or that at the same time that you're interviewing real estate agents, you want to be, astute and ready and get pre-approved so that you know how that you can set those parameters for your home search. So what's next? After you're pre-approved and you've met with your agent and you've started the home search, you find the one, then you write the offer. Maybe there's some negotiation back and forth with the sellers, and then we're ratified. So that means the contract's accepted by all parties. So once we have a fully ratified sales contract, boom, the loan process gets rolling. So from there, we talk to you about finalizing exactly the loan amount, what loan structure makes the most sense for you. Let's lock in your rate. And let's go ahead and make sure we have all your documentation, order the title work, and order the appraisal. And we are rolling on down that hill at a rapid clip for you. This is the part where you get to put your feet up because we do all the heavy lifting for you. Once all those boxes are checked, the loan is out of underwriting, we have full approval, then you're sitting at the settlement table with nothing but your smile and a pen and a driver's license. And then you get the keys to your brand new home. So that is the super quick version of start to finish, how you get pre-approved all the way to moving into your brand new home. Sorry, went a little fast there. So preparing for homeownership. What should you do? First things first, you want to check your credit. I do caution folks that pay attention to Credit Karma. It is amazing for, combating fraud or monitoring your credits, making sure that everything is reporting correctly. Their scores are not necessarily accurate. And what I mean by that is there are different algorithms that are used with Credit Karma versus what is pulled when someone's obtaining a mortgage. And that is across all mortgage lenders. It doesn't matter if it's a credit union, a bank, or a lender like ourselves. There are completely different algorithms that are used when you're buying a car, applying for a credit card, or obtaining a mortgage. So just be cautious. Credit Karma can intend to inflate the credit score. So it really is important to make sure you know exactly what you're working with. You want to determine some goals. Where do you feel comfortable that you could, shop in a price point? Mostly, what's that payment feel like? Are you comfortable making that payment every single month, day after, month after month? Can you lay your head on the pillow at night knowing that you can still go buy that pair of shoes that you want or go out to dinner on Friday night? You want to be comfortable with that monthly payment. What I coach most of my clients on right now is if you're comfortable with the monthly payment and the amount of money you need at the table, that's all you need to worry about. In this environment where we were super spoiled a couple of years ago, don't worry about the interest rates. They'll float back down. We'll refinance you. You'll save some money down the road. But I know it's an ongoing joke, but you really do want to marry the house and date the rate. We'll get you through it. But as long as you're comfortable with that payment today and the amount of money you need at the closing table, Those are the two primary things you should focus on. Call the lender, obviously, get your full game plan in place, save additional funds if that is deemed necessary, make any credit improvements should that be necessary. And then obviously you want to talk with your real estate agent and begin the home search. Things you don't want to do. So these are the big red flags, things you don't want to do. Don't go out and buy the Lamborghini or the yacht right before you're ready to buy a house. Try not to change jobs. If you're in the same field and you're still going to be like W-2 salaried, regular traditional income, that's not a big deal. Just be open and honest with us so that we make sure we've got the right things in place for you to have a smooth transition from one job to the other, and we have everything fully verified. What you don't want to do is go from a W-2 type job to a 1099 or commission only job. That we do need a 2-year history. So you just want to be careful, and always ask. If you're uncertain on making a change, just ask us and we're happy to help guide you in the appropriate way. You don't want to open any brand new lines of credit cards, buy furniture, buy appliances. These are all things that we would consider major purchases. You may want to pay down some debt, but don't do it with cash. Cash is not traceable in the mortgage and banking world. So if we can't source where the money came from, we don't necessarily want to see you pay off something with cash that we can't track back. You don't want to miss any payments. You don't want to move a ton of money around. The more you move money around, the more paper we have to ask you for. So we try to help you avoid that. And you don't want to co-sign on any other loans. Unless it's super necessary. And again, just let us know so that we can tell you, yes, you are in a position to do this, or you should hold off. So how much can I afford? So there's a lot of different things that go into making sure that you can afford. We're going to look at your gross income, and then we're going to offset it with your existing debts. We're going to roll in that new mortgage payment, and we're going to come up with a calculation. And depending on the loan program, it will ensure that you are in the appropriate ranges for those particular programs. So what is being pre-approved versus being pre-qualified? Pre-qualified is completely unverified information. So it's good and it's quick, but it isn't necessarily rock solid. So the difference in becoming pre-approved is we fully verify your information. We're going to verify your income. We're going to verify your assets. We're going to look at everything so that we can strongly stand behind the letter that we're going to provide to you and ensure that listing agent and their sellers that you're going to cross the finish line with us, barring any property related items that would be unforeseen by anybody. Another extra perk that Intercoastal Mortgage offers that sets us apart from some other lenders, we're one of a handful of lenders nationwide that have the ability to do what's called a soft credit inquiry. This means it's not a hard hit to your credit. We can pull back the curtain. We can see absolutely everything that we need to see and still issue you a full pre-approval without that hard hit to your credit. Now, the asterisk there is that once you have a fully ratified sales contract, we will at that point pull your actual credit report. And we have successfully shown since we've implemented this that the credit score lines up exactly. So we're not getting any new information that we didn't already get on that soft credit hit. So it's a big difference when you're able to present a true pre-approval letter with your offer versus a pre-qualification letter. What's in a mortgage payment? A lot of people are not aware of what's involved in a mortgage payment. So you're going to have the principal and interest payment. So the amount of money that you borrow and the interest that is going to accrue on the loan, your real estate taxes that you're supposed to pay annually or every 6 months, that's going to get divided by 12. And so 1/12 of your annual real estate taxes will be included in your monthly payment. Same thing with your homeowner's insurance. We're going to take that annual premium, divide it by 12, and a portion of that goes into your monthly payment. If there's any mortgage insurance that is associated with your loan, that potentially will be in your payment as well. With the real estate taxes and homeowners insurance, those are going to be paid by the lender on your behalf. So that's why you make those payments within your monthly payment. Then we're going to go ahead and ensure that the real estate taxes are paid to the county or the city. And we're going to make sure that your homeowner's insurance company is paid on time so that you're always covered. HOA dues, that's kind of a tricky one. We include that in your housing expense when we're doing your calculations and your ratios. However, it is extremely rare and almost never seen that an HOA or a condo association would allow for escrowing. So typically you're going to pay that separate and apart from your actual mortgage payment. So hopefully that helps dispel any of those rumors. So a lot of people think you have to have 20% down to buy a house. You don't. If in this illustration here, the biggest thing I want to point out is that if we were looking to purchase a house about $450,000, and then we've got some assumptions here again, approximate taxes and insurance of $600 a month, an interest rate of 6.5% for a 30-year mortgage. You know, we're going to assume that the house is going to continue to appreciate at 3.5%. Right now, we're paying $2,500 in rent, but that's going to continue to appreciate as well over time at a rate of about 3%. So if you were to wait for a 20% down payment on a sales price of $450,000, it's going to take you 10 years. And in that 10 years, you're going to pay over $343,000 in rent. And that's a big number. It's a really big number. So let's rewind and flip the script a little bit. If you had $15,000 today, and you put that down, then you are going to end up with equity of $250,000. And the mortgage payment out of the gate is about $1,000 difference in this particular scenario. But again, that pendulum will swing in the opposite direction if you continue to rent, and look at the amount of money that you're going to pay someone else's mortgage that you could be putting that money in your own pocket. So just again, something to think of. Credit. So again, I know we kind of picked on Credit Karma a few minutes ago, but we look at all three major credit reporting agencies. We pull what's called a tri-merge. So we're going to look at TransUnion, Equifax, and TransUnion. And we are going to use the middle of those scores to drive qualification. If there's two borrowers on a loan application, then we're going to use the lower of the two middle scores for qualifying. So how's your score made up? So the FICO score is going to be, 30% of amounts owed. So credit utilization is a big, big thing. I've seen people have points taken off for having simply high credit utilization. And what does that mean? If I have a $10,000 credit limit amongst all of my cards and I'm carrying $8,000 total amongst those balances or about of the availability, then I'm going to lose points for that. Now, if I only owe $2,000 on there, I'm going to gain points for that. So utilization is a big thing. Taking out new credit, that's going to, eat up some of your points. Length of history that you've had your credit outstanding, that's a big one. The longer you've had credit and good credit, the more points you get for it. Credit mix, what does that mean? That means you've got some credit cards. It means you've got a car loan, maybe a student loan or an installment loan of sorts, and possibly you've had a mortgage or you're obtaining a mortgage. So it's not that you just have one credit card and that's your only debt. And then payment history, that is truly the biggest one. As long as you're paying all of your stuff on time and the appropriate amounts, you're going to get good points for that. So what's a quick and easy way to kind of hack the credit reporting? If you're new to credit, ask someone that you have a good relationship with if you're able to go on as an authorized user to a credit card. That's a quick way to get, now, assuming they also have good credit history. That's a quick way for you to gain some great points out of the gate. Again, fresh credit is going to take a while, or if you only have minimal credit, maybe you've just got a student loan and a credit card. If you're added to someone's credit card, you're going to inherit all of their positive history, and that's a quick boost to your score. Again, I kind of already went over this. I didn't mean to jump ahead, but utilization is really probably the biggest driver that you want to pay attention to, because the higher the balances are, then the less points or the more points will come off and it'll drop your score. So you really want your utilization to be definitely under 50%, but the target for the best score with the algorithm is around 30%. So what types of income do we look at? We look at salaried borrowers, hourly borrowers. So if you're hourly, we typically do need to see at least a 2-year history. Commission, same thing for sure. And to count bonus income, we definitely need to see the history that you've been paid that income year over year. And then we will also verify with your employer with the likelihood that type of income is going to continue. We have a lot of self-employed borrowers, so that's going to mean 2 years tax returns. So we have to analyze an average between the two. Now, another kind of asterisk to that, if you've had your business for 5 years or longer, then we may only need 1 year tax return, depending on if you're still in the conforming loan space. If you're in the jumbo space, it's always 2 years no matter what. Part-time work. Even if you had a full-time job and a part-time job, or you have 2 part-time jobs, we do have to have a 2-year history of working more than one job so that we can count that income. Then there's also passive income, interest and dividend income, retirement income, and rental income as well. So you have to have that history so that we can use that in your calculation. Acceptable sources of down payment. This is a big one. So typically it's coming from your checking or savings account. A lot of people either do a 401k loan or they do a withdrawal. You are allowed to do a hardship withdrawal to purchase a home. But again, you want to make sure that that is the most advantageous avenue. If you're in a position to do a loan against your 401k, that's going to be better for you so that you can avoid the taxes and the penalty. You can get gift funds from a family member. The qualified family member list has expanded to what it used to be. So it gives you a little bit more leeway of who can actually gift you the funds. And then there are some down payment assistance programs and grants that the state of Virginia for sure offers. Maryland and DC have their own versions as well. And some of the counties locally will also have niche programs that you just have to drill down on what their specific requirements are. So loan options, there are so many. So we're only going to hit the tip of the iceberg tonight. So we've got, just on the quick high level overview, you've got FHA loans. It's a federal loan. VA loans for my veterans out there. Thank you for your service, first and foremost. So our VA loans, we'll dig into that a little bit more. Again, a government loan. Virginia housing, the state of Virginia, most of you, if you've been around a while, or if you've ever, noodled around in the mortgage world before, Virginia housing used to be called VHDA. But they dropped some of it and now they're just Virginia housing. USDA, same thing. It's a government program. And then conventional financing options. Those are what we would call your traditional mortgage options. Freddie Mac, Fannie Mae, backed loans. And then again, there's county assistance potentially available. So FHA loans. It's not just for a first-time home buyer, so anybody can utilize FHA loans. They do allow for slightly lower credit scores. They will allow for a higher debt-to-income ratio. You only have to put 3.5% down. You certainly can put more, but their minimum requirement is 3.5% down on an FHA loan. There is upfront mortgage insurance that's rolled into the loan amount, but that gets rolled into the loan amount. And then what I was getting excited to tell you is that their monthly premium just recently went down. So it's a huge cost savings to your monthly payment. So FHA mortgage insurance, quote unquote, never goes away unless you refinance. If you've paid down through several years, it will eventually go away. It isn't permanent, but typically most people will refinance to get out of it before that length of time has passed. VA loans. This type of loan is for a veteran that is entitled to utilize this program. You can be active duty or you can be separated from service. You can finance up to 100% of the loan amount. There is a funding fee associated with this loan. However, if the VA classifies the veteran as 10% disabled or more, then you could be exempt from the funding fee, and that's a huge cost savings. There has always been a rumor about, and I used to believe it myself in my beginning of my mortgage career, is that you can't have a non-spouse on a VA loan. You don't have to be married, but they will not allow you to finance 100%. They do have a calculation and you'd be required to put money down, but you do not have to be married to be on the VA loan together. You just have to have a down payment. If you are married, then c'est la vie, have the 100% financing. We're all good to go there. There are different county loan limits and there's calculations, so it's not necessarily as it's going to be perceived. We've done extremely large VA loans for some of our veterans, so it is possible. Virginia Housing, y'all, they have so much to offer. So they will offer you first-time home buyer programs. They also offer FHA, they offer USDA, they offer the conventional financing. They really have a huge platter of options. So you have to be a first-time home buyer on most of their options. Their conventional option has two parts. One, you can go with a no mortgage insurance option. That rate's always going to be a little bit higher. That's how they're going to offset. Or they have a reduced mortgage insurance program. So that rate is a little bit less. Again, the FHA financing, VA financing, rural housing, which is USDA. The great thing about Virginia Housing, they have a grant. So if you meet the requirements for the grant, they will give you up to 2% on a conventional. So what that means, if you're putting 3% down on a purchase of a home, they will grant you 2% of that 3%. So you're really only putting down 1%. So that's a huge savings. If you do an FHA loan with them, then they'll give you 2.5%. Same thing, you're still only in it for 1%. So it's a big difference. They will also do something that's called a second plus. So that gives you the ability to, in effect, finance 100%. Again, there's different criteria. We can certainly, schedule one-on-one calls to go over anyone's particular scenario. But this is a huge thing for people that don't have money set aside to put down, or only have a little bit of money. You might as well let your money work for you. You don't need to necessarily pour it all into the purchase of the house. They do have closing cost assistance grants. It doesn't always, well, you have to be careful. We want to look to see which grant is going to benefit you more. Is it going to be the regular grant for down payment assistance or the closing cost grant? So you kind of play around with that. They won't let you layer the two together. There's also the option for a mortgage credit certificate. And then they also have what's called Spark funds to help with communities. So again, that's going to dial back to county specific to see if they have those funds still available to be used. They typically run out of them pretty quickly, but sometimes they replenish them throughout the year. So it never hurts to continually check on that. The big thing to note with Virginia Housing is they are going to not only calculate your qualifying income, but they're also going to calculate household income. So that means if you have a parent living with you that is drawing Social Security, even if they're not on the loan, that income is going to count. If you have an 18-year-old that has a part-time job while they're going to college, but they have income coming into the house, that's going to be counted in the household income. So it could push you out of qualification. So just something we all have to be mindful of when we walk through that. USDA loans, they are a little bit more challenging to find in this Northern Virginia area, but they do exist. It doesn't mean you have to go out far west to only qualify for this. You're going to find more opportunity the further west you go. But there are pockets of what they call underserved areas. So this is driven by the address. There will still be income restrictions associated with this program, and they do have a 1% fee that they add. That's kind of their mortgage insurance, if you will. And then there's also a monthly fee that comes along with it, but they will allow you to finance up to 100%. So that's a nice feature. We have Freddie Mac and Fannie Mae with the traditional conventional mortgage options. They've got a home ready and a home possible option where it only requires 3% down. You don't necessarily have to be a first-time home buyer to take advantage of this. You do get reduced mortgage insurance, and we only count the income documentation that we put in the file. So whereas Virginia Housing, they're going to still calculate not only the income in the file, they're going to ask about the household income. On Freddie Mac and Fannie Mae's program here, they're only going to count the income that we put in the file for who's on the loan. So that's, a huge part there. There was a new Freddie Mac program that was rolled out earlier this year that's called their LLPA program, which just means in mortgage talk that there is loan level pricing that is associated with different, debt to income, your loan to value, the type of property, the location of the property. There's all these other things that kind of go into the pricing of that. So this kind of peeled away a lot of those costs that are normally injected to calculating what that particular rate would be. So it's been a huge benefit and huge cost savings to a lot of first-time home buyers. And the nice thing about this program is that conventional loans up to 726, you'll go to 100% of the area median income, which is quite generous in this area. And if you're in a high cost area, you can go to 120%. So that's very generous compared to the other programs. Most of them, you have to be at 80% area median income. So it's a nice perk. Again, county assistance, there's a lot of stuff that's out there for first responders, for our teachers, our doctors, our nurses. So there's a lot of specific caveats that come with them. I do not claim to know all of them. So we really just want to drill down on any particular program that you locate in your particular county to make sure that we are meeting all of their specific requirements. And just a quick note on ADU programs. A lot of the counties do offer them, and that's an affordable dwelling unit. A lot of strings can come attached with those programs when it comes time to you potentially trying to refinance or sell. So you just really want to make sure that you have read all of the fine print so that you know what the county has at stake to claw back, if you will, when you go to sell or refinance the property. They can actually, I've seen them be able to prevent someone from refinancing. So that was really fast, actually. Oh, are we over? So that's really it. I hope everybody learned something. I know that we went at a really quick pace. So let me know what questions you have.
Let's see, Angela, we've got, someone's asked, what is a jumbo loan?
So jumbo loan. So it depends on where you're buying, but it's going to be based on the loan amount. So hang on, I'll give you our new, hang on. Let me stop this share here real quick. And I'll give you hot off the press. Because, you know, it's still new in the year. It's like when you're writing the dates, you're still writing 22. I'm still left in last year's max loan amount. So bear with me just 1 second. I want to give everybody the brand new limits. Okay, so a conforming loan, you're going to be up to 726,200. And then high balance in our area. So we're in a crafty little area. We get a little bit of extra love. That's $1,089,300. So once you go to $1,089,301, then you're officially jumbo in this area. Now, if we're talking about other parts, then as soon as you get over that 726.2, you're considered jumbo.
Okay.
Any more questions?
I have one for you, Angela. Sometimes first-time home buyers, when they're trying to jump in, they're trying to get an understanding of how much is out of pocket, And so whether a 3% down loan is an option for them, or every once in a while they'll hear about like a no money down loan as well. What is your opinion? Are you a fan of any type of loan product that would come out that offers no money down, or are you in the camp of, you know, you always want to put a little skin in the game if you can? Where's your opinion lie on that?
I mean, I really feel like it's going to be case by case. I love VA financing for the sheer fact you can finance 100%. I think it's a massive benefit to our veterans and one that they should certainly take advantage of. I have a borrower right now. They've got the ability to put some money down, but their money's earning really good interest right now. And to turn around and take equity out of your property is always going to be a process. So I guess I'm on both sides of the fence, if you will. I do think it's smart to have some skin in the game because you're building that equity much quicker. You're not starting at the max point. I think that we have come a very long way from where we were years ago, where the bubble burst. Lenders, now there's still going to be some out there somewhere, of course, but most lenders are not over lending on properties, thinking that the appreciation is just going to be so rapid that they'll be under that mark in no time. There's no negative amortization loans out there. If there are, I'm not privy to them, and I wouldn't offer one to a borrower. You know, unless it was like a super unique circumstance. But yeah, I guess I'm indifferent. It's case by case. It's going to be borrower by borrower. I think that in certain circumstances, you need to have some skin in the game. But in others, if you can finance that 100%, why wouldn't you take advantage of it? So.
Sure.
Excellent.
There's another one that came in that says, is there a maximum number of mortgages that one person can have?
So it varies. It used to be 10. Freddie Mac and Fannie Mae have kind of loosened up on that a little bit. And then we've got certain investors that will have their own requirements. So it's not necessarily a straightforward answer. It's going to be, let's talk about your specific situation. Let's see how many finance properties you have, and let's see what options we have available for you. And if one of those options makes sense, or do we look at ensuring a property is paid in full because going the traditional route is more beneficial than some of the other potential options we have for you.
I've got another one about first-time home buyers, because I find this environment so interesting, because they've got a lot of different qualms, a lot of different fears. They're not sure, do I step? Do I wait? Do I, it's this
like double dutch
sort of, this kind of ring around the rosies of, at what point is it my turn, and what do you see as one of the biggest fears that it might not even be reality, but something that is expressed, from that first-time homebuyer standpoint, that is like, hey, if this is you don't need to worry about this,
Yeah, I think it is. I think a lot of it with social media, with the media in general, there are a lot of fears that are put out there up close and personal. And it's really easy to believe all of them. And I think, honestly, getting in touch with an expert that can sit down with you and explain to you that it's not as scary as it seems. Is it a big responsibility? Absolutely. It's the biggest purchase you're going to make in your entire life, but it's a legacy purchase potentially, it's something that you should highly consider doing, and it's a good place to invest your money and your time. The only thing they're not making any more of is dirt. So you definitely want to have that opportunity to have your stake of claim and get in the game. Because if not, it's just going to continue to pass you by. And it's just going to get more expensive. Again, the rules have changed so drastically since the bubble burst. I highly doubt. Now, will pockets of the United States experience that again? Possibly, because if you've got some pockets of the nation that appreciated 50%, then that's a problem. But in this area, we appreciated, but we didn't appreciate anything that insanely, so I think it's just jumping in the game, jump in the deep end. Don't be too afraid. You'll make sure you have the life preserver. That's why you want to talk to a professional such as yourself or me, and kind of dispel specific, misconceptions someone might have directly about it. And again, a lot of people right now are claiming that they're very scared of the rates and they're just so high. I know I don't look it, but I've been in the business a long time. And I remember when the prime rate was 8.25%, and we didn't think anything of it. I mean, maybe it's because I was young and dumb, but, we didn't think about it, and people were paying astronomical rates. I never would have thought we would have seen the rates we saw in 2020, but we did. And a lot of people took advantage of it, but they just, quite frankly, were not realistic rates. We're back kind of in that normalcy, but I think, and maybe it's a little on the high end right now, but I think anytime you can have a mortgage rate at the end of the day with a 4 or 5 in front of it, you're winning for sure.
That's awesome, Angela. Actually, that sparks a topic or a final question for us to end on. With so many of our homeowners having, 3 and sub 3% interest rates right now on their mortgages, the desire, the drive for them to sell that home is lower, which is only spurring the inventory problem that we're having. But for those individuals that may want to buy another house without selling their house and utilize a company like Freedom Property Management to manage that home and to put a tenant in place, how much of that monthly rent can they use to offset the mortgage on that 3% interest rate? with qualifying for a new house?
So what we'll take is we're going to take that lease agreement. We need it to at least be 12 months. And then we're also going to do a rent comp schedule. So again, depending on how much, let's just assume the equity position is in the house they're departing. We'll do a rent comp schedule, and we're going to take 75% of that to help offset the payment. And again, if you're at a 2 or 3% interest rate, payment's pretty darn reasonable. So with today's rents that you can collect on it, in a lot of instances, we're showing the borrowers cash flowing positive, or it's at bare minimum, it is totally wiping out the payment, or maybe $100 shortage that we have to count against you. So it's a pretty good push that we get to cover and help offset.
Excellent.
So
That is awesome. We are a little after 7:15, and this went by very, very quickly. Any final kind of parting words, finalizing words, Angela?
if you have any specific questions, please, I know it sounds cliche, but the only dumb question is the one you didn't ask. There's so much we just went over. It was like taking a drink out of a fire hose. In fact, Rebecca and I, when we were going over it the other day, said, this could be multiple webinars. So we talked about maybe we do like a mini series and we go over stuff a lot more in depth. So that was a super fast, super high level overview of the process and some of the nuts and bolts, but I would highly encourage one-on-one conversations. I'd love to connect with you to make sure that we're putting you on the right path and helping to navigate you to homeownership.
Excellent.
Excellent.
Rebecca, I'll let you wrap us up.
Yeah, thank you so much, Angela. The home buying process covered. So many interesting talking points and areas that we can branch out further conversations with our clients. So we're super grateful for that. There's a lot to unpack there, and certainly people that have specific ones that can come forward, and we can continue collecting all that really good information from you. So thank you very, very much for taking the time with us tonight to go over that, and we'll look forward to following up with you with more specific scenarios.
Yeah, my pleasure. Thank you guys for having me. This was great, and I look forward to doing more.
All right. Thank you so much.
Thank you.
Take care, guys.